Welcome to Morningstar's 3 Stock Picks. I'm Holly Black. With me is Austin Forry. He's manager of the JP Morgan Emerging Markets Fund. Hello.
Good morning.
So you've got 3 stocks for us today, all with an emerging markets theme, unsurprisingly. Where should we start?
So I'm going to give you, first of all, a company called WEG, W-E-G. It's a manufacturing company. It's Brazilian. Unusual to find a really successful manufacturing company in Latin America. And they make electric motors. And in fact, about to celebrate their 50th anniversary later this year. So it's been going a long time. It's a big global player. It's got factories in 4 continents, I think, and it sells all over the world. And we like the company, I guess, for 2 reasons. Firstly, really sort of serious corporate culture. You know, very good focus on the way that executives get remunerated and incentivized. Big focus on value creation and a rather Germanic culture in the organization, which may sound strange, but actually one of the founders was from German descent. So it's a bit like a German company transplanted to somewhere more tropical with better weather. So that's the first stock. And the other reason I should say that we like it is electric motors are a big natural indirect beneficiary of the whole drive towards decarbonisation. So you'll see more and more electric motors in a wider and wider range of applications, and that plays straight into the core of what WEG produces.
And you say it sells all over the world. That's quite unusual for a Brazilian country. I tend to think of them as being more domestically orientated. Yeah,
I mean, it makes manufactured products, you know, motors, other electrical components, and that's a global marketplace. So it has to compete head-on with companies like Edison from the US and Schneider from Germany. And I think that one of the nice things about export companies in general is that they have to be good enough, because nobody needs to buy your products if they're not good enough. So it raises the bar, and WEG's done a great job over a long time, not just domestically in Brazil, but exporting and growing elsewhere too.
And what's stock number 2? Okay,
so stock number 2 is a business called Guangzhou KingMed Diagnostics. And as the name suggests, it provides diagnostic testing services for healthcare in China, which is where the company's from. And just to give you a little explanation there, I mean, if you go and have a blood test or some kind of other medical test done in a hospital, in the West, that test will probably be sent to a third-party laboratory for the actual test to be conducted. So it's an outsourced service. In China, most of those tests are still done in-house in the hospitals, which means they have less volume, it's more expensive, it's less efficient, and so on. But what you're seeing is the rise of an outsourced service business model there in exactly the same way that's happened in the US and in Europe. And I think there's a very long runway for growth because of that. And so that's a nice illustration of what's going on in China, where the service industry is really taken over as one of the drivers of economic growth. And these kind of niche specialist companies can sometimes have an extremely bright future ahead of them.
Okay, and what is our final stock?
Our final stock is called United Breweries. And you know, you can't go that far wrong with beer companies. And United Breweries is the leading beer company in India. 50% market share, owns the Kingfisher beer brand, which may be familiar to some people. And I'd like to talk about this stock for 2 reasons. Firstly, I think it's a good illustration of patience and how you need to think about what really matters and what's actually not that important. You know, we bought this stock originally 10 years ago, 11 years ago, in fact, and the chief executive was a notorious playboy. He was the son of the founder. He was running the business extremely badly, but the basic asset was exceptionally valuable. You know, it's really rare to find a consumer-branded company with 50% share of a really underdeveloped market. And the long and the short of it is he eventually over-leveraged himself, lost control of the company. It's now a subsidiary of Heineken. So the Western multinationals have come in, the governance has changed, the operating standards have changed, and that's a business that is just far too small in the long run for the opportunity that's in front of it. So we think it has many decades of growth ahead of it, and that's the kind of thing we're looking for.
And is beer big money in India? I tend to think it's growing in a lot of emerging markets, but you don't hear about it so much in India.
Well, beer is a difficult industry in India. You know, there's no point denying it, and I think there's 2 reasons for that. Firstly, it's not as socially embedded as perhaps it is in countries like the UK. You know, when we bought the stock, there were as many licensed outlets in the whole of India for a 1 billion plus population as there were in London. And that maybe tells you something.
There are a lot in London.
about the British too. But I think that what you see is a desire for leisure and you know, having fun with your friends and going out to bars. So the kind of things that eventually lead to much more consumption are probably in place. The regulation will probably need to change a little bit over time. But you know, originally we paid $1 billion market cap for the company. And that's just tiny when you think of how much of the global population you're covering with that kind of footprint.
Austin, thank you so much for your time.
You're very welcome.
For Morningstar, I'm Holly Black.